I always think of Polygon as kind of like being this nice thing where like, yes, we've got like this chain that can capture like a lot of value, but there's this like much bigger picture, higher potential thing that pretty much anything else in Web3 via the Agglayer that actually connects all of it together.
This episode is brought to you by Skale, the next evolution in layer 1 blockchains. Explore the gas-free ecosystem at scale.space/ecosystem and follow their journey on X at Skale Network. Thanks to Skale for making today's episode possible. Nothing said on Empire is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the companies, funds, or projects discussed. All right, everyone, welcome back to Empire. Very excited about this one. We've got Marc, the CEO of Polygon Labs. We have Sandeep, the CEO of Polygon Foundation. Very, very excited about this. So Marc, Sandeep, welcome to the show.
Thanks for having us.
Yeah, I'm excited about this. Okay, so there's a lot that I want to cover. The reason I want to do this is you guys just launched Katana. Sandeep, you also just had a bunch of updates. You're moving back into this CEO role, or I'm not even sure I got that right, but I want to there's all these updates around what I'd call the broader Polygon ecosystem. And Sandeep, you and I had a bunch of interesting conversations in Dubai at Token, not just about Polygon and Katana, but just about the industry, what it's like to have run a company or foundation protocol in the industry for many years. And so just wanted to do this episode to talk about like Polygon, Katana, but more broadly, just like where the industry is going. So Sandeep, I thought that would be an interesting place to start is you've been, running this business. I don't know if that's even the right word to say running this business, but you've been operating a protocol in the industry for a very long time. What is your general sense of like the industry today and how it's changed? We were just talking about what it was like in 2020, building something compared to today. Like, what's your sense of what the last couple of years have looked like and your sense of what the industry is like today?
Yeah, I think in a lot of sense, we all know that this industry, basically we literally all joke that, 3 months is like 1 year, right? In this industry. And I think like the, one of the things that you can say is that especially after 2022, the change of the acceleration has, basically what should I say? The acceleration of change is even more because, we have seen so many things changing recently. The government changed, regime changed, complete new, I think last, maybe 7, 8, 10 months back, none of us thought that, people would be doing you would have the best performing coin of the market right now is something that is doing direct buybacks on daily basis. This is previously, I think, very, kind of a scary circumstance. But I think now that, and this is the right way, I think most of these, the tokens, previously there was a very, very kind of I would say very abstract separation between the utility versus the utility versus the revenue and all that. And I think now we are seeing more and more of those things getting tied together for, in various different mechanisms. Some are more pure, the traditional protocols, whereas app protocols, what I call app protocols, they are a different way. But I think that is changing. But the point being that the industry changes a lot, and now the change in industry is even more, suddenly we saw meme coins. Last year it was meme coins, and then people, you see, if you see from a zoomed out level, we went from saying that nothing in this industry works, so let's go only on meme coins, and it's like a casino game, meme coins, just do this because nobody is delivering anything, there is no revenue on anything. Why do you need all these roadmaps and teams and presentations and whatnot? Just have meme coins, no roadmap, nothing, pure speculation. To now, people are saying that, okay, people are now judging protocols on revenue, right? Which is, actually the part of the fundamentals. And all this happened maybe when did the Trump coin happen? January? So in last 5 months, right? 5 months before, meme coin was, Trump was the peak of meme coin, right? And then after that, now the meme coins are gone and all that. So the industry changes so fast. But I think the biggest kind of thing that I see the change for the good is that infrastructure wars are kind of, I mean, they are still there, like projects will fight, but I think the markets, mm, markets have stopped betting on purely infrastructure wars. Or maybe let me think of a better way of saying that thing, articulating that thing, that the infrastructure basically previously was, we are building this crazy thing, and this, that, narrative was there on infrastructure, that this infrastructure will achieve something in future. Now that infrastructure thing, people are asking, what is happening right now? Tell me what is happening right now, right? What is the revenue right now? How many people are there and all that? So the parameters are actual parameters, and it's all about users, how many users you have. And I think like more and more chains implicitly are becoming app chains, like app specific chains. Even the mainstream chains that you see, the general purpose chains, some of them, are already choosing. Like I would say Polygon POS, even though it's like by nature, by design, it's like it's a general purpose chain. But if you see in the last 8 months, we have focused very heavily on payments, RWAs. In a way, you can say that that's the core focus area. It's an app specific chain for payments and RWAs, right? While, poly markets like, of the world and courtyards of the world still exist on that chain, and they get benefited with that. But I think that is one of the biggest, kind of change. I see that narratives are no longer the main thing of the industry. So the best marketer wins. It's all about now the products and how can you have more users and distribution.
Do you think it's easier or harder to run a business today in crypto than last cycle, or a chain compared to this cycle, or last cycle?
Chain is definitely harder to run. I would say any kind of token, kind of venture, token-based venture, instead of equity-based venture, is much harder. Like even previously, previously they were like, markets were good. There was liquidity for these assets in the market and all that. Now, if you see the token, literally, I tweeted about it also. The token literally adds two key values to your project. Like first is that it can give you early, investment ability, right? I was just talking like few hours back to a founder. They had raised like prominent project. They had raised like $80 to $100 million, and while on the white paper and this hype cycle and all that. And I said, like, if you were in Web2, $100 million means like, no matter what kind of profile you have, you could raise like $20-30 million. But beyond a certain time, then to raise the $100 million round, you have to have like revenue, users, this, that. It's very hard. So tokens were, you could do that before. And the second value that token added is that, okay, if you are a founder, even if you are not like exit scammer and all that, but after first year of your listing, 1 year, you will get like maybe some percentage of your tokens, and you can be financially safe and all that, which is unheard of in Web2 world, right? Like you have to grind for 10 years, and then after some sort of exit happens, and then also if you don't have too much of, you have not sold too much of preferential shares and all that, you probably make something which can save you or make you comfortable on the financial side. So these are the two main values. Apart from that, probably airdrops brings you some early user metrics. With that too, also, like I think only 10% of that is real. But apart from that, like token adds net negative value to you, right? Like you are constantly being ridiculed if the token price is not doing.
It's funny you say that. I mean, I was at a thing a couple weeks back, and there were like, I forget if it was like 6 or 8 of us around a table, and we were just I was like asking people like, who's having fun? Like it was only founders around the table, and the people with a token, it was like, let's call it 8 people. 4 people, they have tokens. They're miserable. All 4 of them, just miserable. And the four folks without a token were having a bunch of fun. And that feels like actually the first time in the industry where that's happened. I remember in 2020 and 2021, like, talked to you about this. Like Mike and I had a lot of FOMO because all of our friends were building these. It was DeFi summer and then NFTs, and our friends were building these businesses and literally making hundreds of millions of dollars. It was insane. And Mike and I are like, we're just out here hosting podcasts with no token. What are we doing? It does feel like that's
now you are much happy that you are actually building a business where it has actual users. You are actually like, now you have actually like cash flows and all that. And there is a, growth trajectory. Like in crypto, it's so hard to operate like infrastructure side also, because every new startup that would come, right? they would get funded with 150 million dollars. Like even the cost basis in the industry, like if you are an infrastructure project, like it's so hard to hire people. Like, somebody was telling me that even in India, like, I mean, Polygon, originally it came from India, and they were trying to hire in India some smart contract engineers and all that. And he was telling me, dude, you have destroyed the market. And I said, what happened? I said, like, everybody, like even the college graduates asked me 100K, 120K in India is like a 10-year, 15-year experience person salary. And in crypto people, like, and not even the smart contract, even crypto front-end builders would ask you,
No,
like,
it's funny you say
100K.
this because we, like in the last market, we would lose our people all the time, our analysts and reporters and stuff like that to protocols. Like I remember, it's like anyone from Uniswap or Arbitrum or Polygon or funds, right? VC firms would just hire our people, and we just couldn't afford to pay. And we actually hired a head of people in the bear market, and I was like, get ready. In the bull market, we're going to lose all these people because we just can't pay what the people with the tokens can pay, and we haven't lost anyone actually.
I actually literally remember thinking that I felt bad for like every company that had analysts, because they would literally train them for like a year or two, and then a protocol would just jump in. And
it sucked. It sucked. Yeah, but now we don't lose them because the token performance has been okay. So maybe this is another question, and we'll get away from this topic in a second. But I'm just curious because you guys have been at this for so long. Can you recover? Just like to bluntly put it, like if you've been doing this for a long time and you've got a token that's been down for a while, like can you recover? I'm not talking about you specifically. I'm not talking about Polygon or you, Mark, but like
you can talk about Polygon also. It's fine. Like you can talk. It's a publicly traded thing, and then whatever like views are public. And I think like recovery it's all dependent on macro, right? Like so, especially if you see Polygon and all the like layer 2 ecosystem, Arbitrum, Optimism, all of them, they have been badly hit because of they have a double whammy, right? Like first they got hit with the macro cycle, and the second problem with them is like because of the the Ethereum's L1 position, like little bit like shaken, like people even thinking that this might not be true, Ethereum might not have won, right? Previously, like I remember 2023 September October, before the first meme coin mania cycle, we were in very prominent event, I think Anti-Meridian from Dragonfly people, and there the topic was, and I was also on the panel, the topic was Ethereum has won, stop fighting Ethereum, right? Something like that, right? Like that was the title. And then the meme coin mania came, and situation changed in 2024 and all that. And so that created a lot of pressure on everybody who's building an Ethereum ecosystem, of course, obviously. And then obviously the macro, liquidity situation is very, very, very bad, right?
Yeah. But I also think, like I like refuse to believe this idea that if you build a great product that people want to use, that people are not going to attribute value to what you're building, right? And I think like that's the hardest part, right? Which is it's so easy to steal users with like a new token, sending money around, and like you take away users. But if you actually have like a long enough like time horizon on this that you can associate with it, I think the perspective changes a lot. Like when you can start saying, hey, I've got one application that is sticky with a lot of users. I've got 2, I've got 5, I've got 10. And by the way, like go look at like the rate of change in the development of the protocols that we're building, and go look at the kind of innovation that we have at like the front end of like what's coming next. I think what people start seeing like very quickly is like, oh, this is something that actually is built to last. And that doesn't right away turn into like something happens to your token price, immediately does. But I think as the industry matures more and more, and Sandeep just touched on this, right? Like the idea of like actually going to fundamentals a little bit away from like just like, pure like pumpamentals. You are going to start having people like attribute value to that. And people want to see like how sticky is it? And how real is it? And I think when you prove that over a long enough period of time, it doesn't matter like what your token price looks like at that time. Like it's going to be impacted in a positive way.
Yeah. There's a phenomenal episode of Invest Like the Best with Patrick O'Shaughnessy with this guy who it's about Carvana's stock. And if you look at Carvana's stock, this is what Carvana's stock looks like. It during COVID, it ran up from like $40, actually earlier, $30-$40 to 360. And then over the course of 2 years, proceeded to go from 360 to $4. And obviously everybody thinks that's okay. It's only a COVID business. This business is cooked. It's over. And now it's actually back to, a $70 billion market cap at 330. And if you compare that to something like maybe Peloton, right, which went up and then has not recovered. This was more of a COVID stock. Like I agree with you, Marc. Like in the long run, the businesses that do build products and make good money actually do end up doing well. It just sometimes takes longer than the market wants to, than you want to realize. So. This episode is brought to you by Skale, the next evolution in layer 1 blockchains. With a gas-free, invisible user experience, instant finality, and robust security, Skale allows for limitless scalability and has already saved its 50 million users over $11 billion in gas fees. Scale's high throughput, zero transaction costs, and powerful Web3 infrastructure make it the ideal platform for gaming, AI, and other high throughput apps. To explore the gas-free ecosystem, visit scale.space/ecosystem and follow their journey on X at Skale Network. That's Skale spelt with a K. Thanks to Skale for making today's episode possible. As always, investments in blockchain technology involve risk, terms, and conditions apply. Sandeep, tell me about the return to, so you had this tweet, I can try to pull it up, but while I'm pulling it up, you said big update as the largest holder of a poll and someone who has dedicated his life to the development and success of Polygon from the very beginning. I've decided to take full control of Polygon Foundation and will be its CEO going forward. And there's many sub bullets of this, but tell us about this decision.
Yeah, I think like the most important thing is that Polygon Foundation is basically the you can say that Polygon Foundation holds the the treasury traditionally of the pool tokens, and also funds a lot of entities in the ecosystem like Polygon Labs, which is like the most prominent kind of contributor into the protocol, but there are multiple small entities also like that. And Polygon Foundation, like when I was building the the protocol, like obviously back in 2022 2023, Polygon was in 10 to 100 phase, right? Before, like when Ethereum was this thing. And I mean in all this thing, like Polygon was the first breakout chain which had so many applications breaking out and all that. Even now, like Polymarket and Courtyard and many other applications keep doing very well. Payments are doing extremely well, by the way. So basically at that point in time, like I started to build Polygon Foundation as a more institutionalized form, preparing it for 10 to 100 stage, right? Yeah, I mean when I'm saying 10 to 100, I mean like 0 to 1, 1 to 10, and 10 to 100 stage of ventures. And that included like a lot of board formalities, this, that, everything set up in a way where like now it's a very big ship, so you have to steer it very carefully, this, that, right? And what I was explaining, like because of like Ethereum getting into a lot of pressures from the the L1 ecosystem and all that I think that pulled all of us right back into, and I'm sure this is the same situation with all the other L2 protocols also, is that it pulled all of us into this, I would say, 0 to, like Polygon could be like still in 1 to 10 phase, but I just like to think that we are in 0 to 1 phase back altogether. And then that's where you need like extremely fast decision making, bold decision making. Sometimes you will take kind of wrong steps and all that, like for example, incubating Katana, right? Like is one of the many steps that we have taken, right? Like it's a incubated with GSR, an completely external project, but the Katana is a very important part, we believe, for growing Agglayer, right? So the Agglayer, as we know, like that's the main product of Polygon. Like that's the future. Like we believe that this has a potential of becoming an important element of this trustless internet that we are building. With the assumption that everybody, all big enterprises, and you can already see this, by the way, right? All the big ones, you see that Robinhood to Revolut to Stripe, like all of them are entering. Eventually, all of them are going to launch their own chains, right? And so Agglayer is basically a service which provides this cross-chain settlement to these chains and whatnot. And if you want to create that service, and you assume that there will be separate business activity happening on multiple different chains, you would need like some liquidity hotbeds, and which are extremely fast, native to it, right? Like those hotbeds do exist outside, like just like Polygon POS, you have Solana, Base, other like high liquidity places, but they are not natively connected to Agglayer. Like you need a native deep liquidity hotbed where people can easily trade those assets. So that's why, like, that was the reason why we kind of incubated or helped in incubating Katana, because it's a very important. We believe that it could play a very important role in the success of Agglayer. So that's why, like, so basically these decision making was becoming slower, like with the boards and all that. Every time you will review what decision, even if you took some decision, you go back, and many times I and Marc used to discuss. And obviously Marc, running the business team and all that, would also, time and again would say that, sometimes like when we revisit the decisions, change the decisions, it kind of affects the morale of the whole team. Like, okay, are we not clear and all that? And I said that, and mistakes happen in that scenario also. Like I said, instead of like, if that mistakes are anyways going to happen, let's take them in a fast way. Like, let's take faster mistakes. If we fail, we fail, right? So that was the reason. So what I have done is, like, I've taken the CEO role of the foundation, the board and all that. Like, now I am the main person on the board, and then we can, like, I can take with Marc, like, whatever decisions we need to take, we can take extremely fast, move extremely fast, break things. Some things will succeed, some things will fail. It's fine, but we work in the startup mode again. That's the main crux of it.
What do you think? So there's two business models that have emerged with chains. One is the you guys, I'd say Optimism, Arbitrum, which is like providing infrastructure for other people to go build their own chains. Or maybe that's an overly simplified version, but Optimism has the OP stack. You guys have Agglayer. These all kind of look directionally similar. Then there's like, hey, just come put everything on our one chain. Solana, maybe Base. Like, it seems like Hyperliquid's going in this model, maybe kind of. What do you think about the two models? And do you think one is, I mean, obviously you guys have chosen how to do Agglayer. I mean, we haven't even talked about Katana, so maybe that's a different strategy a little bit. But what do you think about these two models?
Yeah. I mean, Marc, I can start and then maybe you can add. Like, we, like, from the very beginning, like, like if you go and read the white paper of Matic Network, which Polygon used to be called before,
right,
from 2017 or 18, that time also I had talked about multiple chains, because I could clearly see that one chain, no matter how much scaling you can bring in one chain, it still cannot take the transaction. Especially, you are not talking about it's not like Visa network. You can say, like, somebody might say that Visa has 50,000 transactions. Like, literally half of the world is using Visa for the transaction. But Visa is only payment transactions. You're not doing complex smart contract logic on that, right? Like, you're not putting code on that. Like, it's a one, like, balance up, balance down, right? And even then, you can't say that the world's, like, the whole world's payments are happening on Visa. It's still a small percentage of the larger. So we don't, from the very beginning, my belief has been that there can never be a one single computer which will take entire world's computation in one single place. That's not possible. So there are going to be different this thing. However, I do agree with one thesis, which I give credit to Anatoly also, that he saw it initially, is that liquidity hotbed, thesis. That, of course, there will be computation many places, but there will be probably one or two liquidity hotbeds, 5 liquidity hotbeds, where there will be a lot of liquidity situated and all that. And that might happen. But that also means, eventually, in our thesis, everything becomes an app chain. If that thing becomes liquidity hotbed, even then it's kind of like one or two kind of apps. Like, probably you can see this thesis, like, for example, unfolding with Uniswap chain, right? Uniswap has like the DEX there, and their thesis is like, between the super chain ecosystem, they will be the liquidity hotbed. Like, wherever you are doing anywhere, the market is here, right? So if, let's say, so in Solana's design also, if that succeeds, I see the end version is not as an ecosystem where people are doing so many things. I see it as one or two large, let's say, exchanges or few exchanges being there, and people using those exchanges for liquidity and all that. But applications will largely move away. Like, you can already see, like, some of the, like, I don't want to name, but like some of the biggest applications in Solana ecosystem has already declared that they want to launch their own chains and all that. And the Ethereum has been talking about this thesis from day zero, and so as we. So
yeah, and tying this back to like Polygon, where I think it's like really relevant is effectively like okay, our like when we think about this like purely from like a very like like traditional sense, like you think we have like this like mission of like building the trustless internet, and we want people to do whatever they want with their assets like whenever they want. And when you like think about what that means, it's not like this like I view building a single chain as like a very small kind of like mission. I view it as like you could create a lot of economic value on that chain for a period of time, and if you evolve with the market, you could continue to drive value in that chain, and that's great. And this is why we love having a chain like Polygon POS that can drive like massive value through payments and RWAs. But by the way, it's not going to be the only payments and RWAs chain in the world, whether it becomes the most successful one or not. But when we think about it like a lot bigger, what is the thing that like really actually gobbles up a lot of Web3? It's the place where all of these big chains need to go to actually be able to interact. Polygon POS is not going to live on its own when it's great for payments and RWAs. Solana, if it wants to be like the on-chain exchange of like Web3, it's going to need to allow users to do other things, and it's not going to do it on that chain. It's not going to be able to like handle it. And so you ultimately like need this place, this thing that allows all of these to connect and actually like interact. And that is the thing that to us is like much bigger, much more valuable as well. And so I always think of Polygon as kind of like being this nice thing where like, yes, we've got like this chain that can capture like a lot of value, but there's this like much bigger picture, higher potential thing that pretty much anything else in Web3 via the Agglayer that actually connects all of it together.
Yeah. And I also want to add, like, Marc said this really good thing. And because many times we internally thought that, okay, should we go, like you must have seen the Polygon's GigaGas roadmap, right? So Polygon POS, like, in next 10 days, we are going to go to above 1000 TPS. And I think by September, October, by almost end of September, you would see Polygon POS at 5000 TPS, right? As good as like any other chain that you can see, probably like, approaching similar ranges as Solana also, you can say in the performance. And we could have done that, like, we can also crank it up, like, and based on all these GigaGas research that is happening and all that, take it to 100,000 over time. That's the plan. But like what Marc said is very important. Like, if you told me that, we are building just one chain and then we just want to bring, a lot of like applications there and all that, and the token does well in the short run, because the long run, we are saying it cannot be everything. In the long run, our thesis, everything is a app chain, right? Like my thesis to this is, and which like Uniswap, you can see in the Uniswap thesis, is that if you had smooth enough cross-chain connectivity and compatibility, like, I mean, the composability also, why would any app exist on a shared chain? Like I would always, any app as a DeFi app, I would always create my own dedicated chain, serve my customers with the highest quality standards. And whenever I need any composability, like, using this, any kind of interconnectivity layer, like I can connect with anything else, right? So that's that mission is actually like, it's been 8 years for me, like you and me were discussing, right? Like it's been a long time. 3 months is like 1 year. So it's almost like 30 years, right? Like here. So, like one of our team members is elder than me. And he said, like, how many years have been for you? I said, like, it's been 8 years, son. And he's elder than me because the 8 years is like 20, 30 years, right? So what I was saying is that this mission actually is something that makes me feel like wake up every morning, even now after 8 years of all this, crypto crap, and still, work 10 hours, 12 hours a day, right? And that's the most important thing. That's why we are chasing this dream to create not one chain, two chain, but create this trustless internet. Like Agglayer, if you see, like, and I would love to do like sometimes a deep dive, and not a lot of people understand like Agglayer, but if Agglayer succeeds, it actually ends up becoming not like one network. It ends up becoming like a trustless internet. Like almost like, people have abused this meme, the TCP/IP of this. But if you see this in terms of the security, it actually is could become the TCP/IP of the value internet. That's what is the bet.
Yeah, I do want to go there in a second. What is the role of Ethereum in all of this, Sandeep?
So Ethereum, in our mind, is the, like, after Bitcoin, is the most decentralized chain, and that is used for the final settlement guarantees, right? So Agglayer actually collates the the ZK proofs from everywhere, creates the final settlement proof, and posts on Ethereum. And because Ethereum is decentralized enough, people don't have to trust on the Agglayer, which is providing this fast interoperability between the chains and all that. They are actually trusting the final settlement on Ethereum. So that's the role of Ethereum.
Yeah. So a couple months ago, before ETH really started to do their transition and like this new pivot and new guys in place and stuff like that, I think there were some folks that probably you and I both talked to who are really frustrated with the state of Ethereum. And, people would say to me, and I'm sure if they're saying it to me, they're saying it to you too, which is, if ETH keeps going this way, I'm going to leave the L1, right? I'm going to do things myself. Did you guys ever think about that?
I mean, you can imagine that, there was a time that every other day this conversation would come up. All our investors will ping, and then they'll say, just because, see, in terms of the money value it can deliver to you, it just like, we just need one announcement that, guys, we are an L1 now, right? And then suddenly, like, the valuation and the pricing is completely different, right? Considering we are one of the most adopted chains, like, we would actually, most of the L1s right now, they will pale if you actually compare the real user statistics and everything compared to Polygon POS, right? But their valuations would be like 2, 3, 5. I don't even want to know. Some of them are completely dead L1s, and they are like, valued like 4 or 5 times higher than Pol. So obviously, most of the investors, stakeholders, there is huge pressure. There was huge pressure. But I think, like, like, people actually, like, this is like, I should say this, like, so a lot of people actually, because Matic as a token did its like 100x bull run and whatever and all that,
right,
they think of me as some sort of like crypto businessman, right? Like, my branding is crypto businessman, right? But I am actually like an engineer. I originally wrote the code also there, and I have a thesis, I have a vision what I want to achieve, right? It's not like I'm just like, people are just thinking, why Sandeep is just not declaring, because they are assuming that I should be doing this anytime, like now L1 pump, like the token goes up and all that, right? Like, but I don't do that. Like, I am actually building for something real. And I definitely, like, Agglayer in its current version is not an L1. It's basically something that uses Ethereum as the settlement. Like, as it decentralizes and all that, like everything, like in future, we don't know. But Ethereum, the Agglayer relies on the settlement powers of Ethereum. And we can't just call it like, we can't go and say that, no, this is an L1 and we'll see when it happens L1 and all that, right? Yeah. So that we won't do. I won't do specifically also.
Yeah, and Jenna, this also ties into the discussion we were having earlier on, like, at least that I started around like this idea of a product. And like, Ethereum is a great product for settlement, period. And so we should keep using it for that purpose. It's actually that simple. And it shows that, like, build a great product and people will use it. And people look at Ethereum also and they're like, hey, it's not a great product because of like XYZ. I like strongly disagree with it. Like, we actually have a need for Ethereum that frankly others don't satisfy. And that is like very useful for us. And so, as Sandeep said, like, when it comes to the Agglayer, like, we post final proofs over there. And like, and honestly, like, if there wasn't Ethereum, I don't know who we would be able to trust from a trustlessness perspective to actually be able to do that.
Yeah,
it's only Bitcoin. It's only like someday, like, Ethereum's real competition is if someday Bitcoin says that we are adding this ZK proving capability into this, then there is like serious competition, serious problem to Ethereum. But right now, like, for the settlement, which we think Ethereum is built for, and I think, like, this is what other L1, especially Solana, has been able to do the best, is that they were able to drag Ethereum ecosystem into a fight, which is an execution fight, which Ethereum is not made for at all. Even if, let's say, like, they are 13 TPS, even if you scale 100x, you still go 1300 TPS. You're still like 1/4 of where, like, let's say 1/3, 1/4 of where Solana, Aptos, Sui, many of these other protocols would be there, right? Why fight that fight? Like, that was not supposed to be Ethereum's fight. Ethereum should have been a settlement layer and all that. But I think there are a lot of, like, in the community, like, the just number go up kind of people, because they want to see the fees and revenue and DeFi volume, everything on Ethereum, so that, like, they can price it better or something. And they, like, I think you compare that with, let's say, this is my disappointment. Like, I was actually discussing with the some Ethereum Foundation people also recently, that this is my biggest frustration, like price and all that. Like I know, like I'm seeing the price. I've seen the bad price in 2020 for years, like, when Polygon's price was at 2 cents, right? Like, I don't care about that. We keep building. If we build a good product, good users will come, things will happen. But I was telling them my biggest, frustration was that getting dragged into this, execution war and leaving your strategy. Because see what happened on Bitcoin in 2017-18 when this, BT, what was that? Bitcoin. What was the other name of the Bitcoin with bigger blocks? Bitcoin Cash. Yeah, Bitcoin Cash, because they said like Bitcoin is actually for payments, like
payments, of course,
yeah. And then the core people of Ethereum community, they put their foot down. They said no, we are store of value, we are digital gold, and that's it. We are not doing anything else. This is what we'll do for let other people build other things. We will do this and ossify it, keep it simple. And I think that's what Ethereum. This is my disappointment. Like I thought that this thought process and wisdom will come from Ethereum community that no, we will not do this. Like in fact, instead of like getting scared by the regular revenue, this thing coming back. No. We are built for settlement. We will only do this. We will make sure that there will be, you can run Ethereum nodes on Raspberry Pi and laptops and all that. And there are so many nodes. It's sovereign resistance, permissionless, because it is the best place for settlement, which also means it is the best place for creating the sturdy value. It is the best place to keep $10 billion, $100 billion. Like if I had like $100 billion or $10 billion, would I keep it on any other chain? I don't think except Bitcoin and Ethereum, anything suffices, right? Like where you would want to safely keep and store your money. So that's where the disappointment from our side, like from my side, especially because I still like I'm still a pretty big Ethereum maxi in that sense.
This episode is brought to you by Skale, the next evolution in layer 1 blockchains. With a gas-free, invisible user experience, instant finality, and robust security, Skale allows for limitless scalability and has already saved its 50 million users over $11 billion in gas fees. Scale's high throughput, zero transaction costs, and powerful Web3 infrastructure make it the ideal platform for gaming, AI, and other high-throughput apps. To explore the gas-free ecosystem, visit scale.space/ecosystem and follow their journey on X at Skale Network. That's Skale spelt with a K. Thanks to Skale for making today's episode possible. As always, investments in blockchain technology involve risk, terms, and conditions apply. I want to start to try to tie in Katana into this whole story. So in your post, you said we will so you guys are deprecating Polygon ZK EVM. Razor focus is going to be on Polygon POS and Agglayer, nothing else. Where does Katana fit into the story? I don't know if this is a question for Sandeep or Marc. But.
Yeah, see, first of all, like Katana is one of many incubations and closely built products in the ecosystem that we built, right? Katana is not
this
like
is your point number 4. You said the Agglayer breakout program is going to continue spinning off projects that will result in increased focus for Polygon POS and Agglayer, big airdrops to poll stakers, and et cetera, et cetera.
Absolutely. So you see that, the core focus of Polygon Foundation and Polygon Labs is to focus on Polygon's core product, which is POS and Agglayer. Now, for Agglayer, POS is very clear, payments and RW, and we are pushing ahead on this, right? Like already, I don't know, like a lot of people are watching those stats. There are like some people have started talking on Twitter also by, in terms of the number of transactions, we already surpassed Tron, like number of transactions, payment transactions. But, in terms of the value settled, Tron settles around 680 billion per month. And we are at 140 billion or something, right? So, of course, like still 1/4 of Tron. But like, if you see like, how market values Tron at 25, 26B, that is also like, completely something that is underpriced in the market and all that. Like, so of course, like not financial advice and all that. I'm just saying as a, founder, my side of like this thing, how I see the irrationality in the market. But Polygon POS, payments and RW. Agglayer is a multi-chain ecosystem, right? It's, in the past, we used to call it Internet of Blockchains ecosystem, right? And providing the final settlement on Ethereum, cross-chain interoperability, whatever. And Agglayer does not succeed without some key initial partners or initial chains in the Agglayer ecosystem. Right? You see that there is an OKX chain, there is Polygon POS is connecting into Agglayer, and then there will be like this chains like Katana, Maiden, all of these chains will connect into the Agglayer, and they will provide the initial network effects, initial liquidity into the Agglayer. And Katana, for example, was one of the, is one of the incubations. Maiden is like a non EVM incubation, which we spun out, and Maiden, recently did a very stellar fundraise and all that. Similarly, there are multiple others. Some of them we have announced, some of them we have not talked. Like Billions, for example, is also on one other project. Like you might have heard Privado ID. They are like now, they are the ID, like proof of humanity plus ID protocol, right? And they are already getting a lot of traction because a lot of projects are using them as the airdrop. You might have heard of them. So these all are like our, incubated projects. Some of them built inside, spun out, some of them built outside and all that. And Katana is one of them. And I was explaining previously that since Agglayer is this multi-chain ecosystem, imagine you were on a game chain and you earned 1,000 game tokens, which equals to $100 in USD. You want to swap it. You want a place where there is like larger liquidity and all that. With that USDT, probably you want to buy ETH, you want to put it in an earn product and all that. So you need a deep liquidity place, hotbed in that. And we believe that Katana has the ability to do that because of the mechanics Katana has. And I think Marc is the best person to explain some of those mechanics because of his DeFi background also. But yeah, that's the background of Katana.
Sandeep, we'll let you get back to your walking desk right now. Marc, do you want to
Yes.
I don't see you walking, Sandeep. We got to get you.
Yeah, because I stopped. Like, while I was talking, I realized that I was not able to focus, so I just stopped.
I can't multitask. I can't do that. But
I realized for the first time that especially in the podcast, like calls I can take, but then podcast
it's tough. Marc, tell us the. So I'll get into more specific questions in a sec with Katana, but tell us the backstory of Katana. Like, how did this thing come to life? Like, was this like several people? Was this your idea, Sandeep's idea? Like, how did you guys have a bunch of partners? Like, tell me the story of this thing coming to life.
Yeah, so this actually started for the exact reason that Sandeep said, right? Which is like we were looking at the Agglayer and we actually wanted a protocol that would, a chain that would actually have like really deep liquidity on it. We went out to the market, right? And we looked across the market at every chain. It doesn't matter what chain it was, just name the biggest chains you can name in the space, POS, Arbitrum, Solana. We said, okay, which one could we just find a way to do a deal and bring them to the Agglayer? And what we actually realized was that none of them were actually good enough for the goals that we had for this purpose. And specifically, the reason for this is because none of them actually have very deep liquidity. A lot of them have very high TVL. Not a lot of them actually have very deep liquidity. When you go look at like the pools that get traded the most, you're talking about things that have like 20 or $30 million of liquidity, which is just like, it's basically nothing.
Marc, can you talk about that difference for a second? TVL versus liquidity. I'm sure this is familiar for some folks, but maybe not for others.
Yeah, sure. So like general idea is you look at a chain and you're like, hey, you look at this raw number. There's $6 billion of TVL. What people think of is they're like, oh, this is the place that I go and I can get lots of liquidity. I can trade really easily. But what happens is that most of the time, that TVL is just assets on a chain, but they're not actually used in a DeFi protocol. You could almost look at this as like DeFi Llama provides like the actual like TVL that actually exists in the DeFi ecosystem. And that is not at all the same as the amount of assets that are actually sitting in that ecosystem. And so the thing when you do is you're a trader and you want to go trade. That all that amount is irrelevant, which by the way is like over 50% in most chains. It's like it doesn't do anything because it's not a DeFi protocol. On top of that, when you actually look at liquidity within those chains, what you actually realize is that they're not actually all sitting in one protocol either. They're also sitting in like 10, 20, 30 different DEXs or lending protocols. And then what you realize is that when you want to go trade, you go look at the pool within one of those protocols that has the most assets that you can trade against, and start realizing that there's not actually that many assets to trade against. The value of those assets is not that much because it's spread out across everywhere, or it's not even in a DeFi protocol. So that's what I'm referring to when I'm talking about this like deeper liquidity, is really like a pool that can actually truly be traded against. So when we were looking at that in the ecosystem, just across the board, we're just like, nothing is built for this purpose. And so we started thinking about like, how can you actually get this done? We actually had their project called the Sync that was actually being worked on about a year ago by an external team. And it was intended to be a project that could be kind of built for this purpose. What we realized actually is that there was a lot of improvements that could be made to this project, and that could really, really focus on solving this issue properly in a way that only like a new chain could solve and an existing chain could not solve it. And so we started kind of like looking at that. And then what we realized is we're like, you know what, if we're building a chain for liquidity, you know what we should probably have is a partner who can help enhance that liquidity in the best way possible. And so that's why this is a chain that's actually not just incubated by Polygon, but also incubated by GSR. They're a liquidity provider, market making firm with, 10 years in, probably 15 years in the industry, almost 13 years in the industry, and very experienced in this way. And so the thought was, if we could build kind of two teams, one that can bring like an ecosystem and one bring the liquidity, then we'd be in like a really, really good spot. And so really that's like the source of Katana is really this idea of like, hey, bringing this to the Agglayer with like the comprehensive team that you need, solving an actual need. Now, one of the things along the way that we realized is not only do we need deep liquidity on the Agglayer, but actually we need a chain that is actually just optimal for users, period. So like, great that we need deep liquidity. So we went and did a bunch of user service. We're like, what do you actually want to do in DeFi? Like, what are the top 3 things that you actually care about? And uniformly, like almost across the board, number 1 is I want high yields. Not surprising, it's DeFi. But also, by the way, that's just finance. Go ask retail. What do I want? Like using Robinhood, what do I want? I just want to earn a lot of money, right? So that's always number 1. Number 2 is I want deep liquidity. This also is not surprising. Go to anyone in finance and say, what do I want? And they're going to say, I want deep liquidity. And then number 3 is security. And so security to us is always like baseline. It's like the first thing that we always think about is like, you're going to build stuff that's actually secure. But those first 2 things are things that like chains do not solve for at all across the board. And that is really the idea behind Katana, which ends up being what we need for the Agglayer. It also ends up building like a better chain for users than currently exists for DeFi purposes.
Marc, you guys made some interesting design decisions, I will say. For example, one is you guys are opinionated on the apps that you guys have, chosen to, like, you have one lending protocol, one spot DEX, one perp DEX. I think I'm getting this right. Tell me about like how you guys came up with some of these design decisions and how you came to those conclusions.
Yeah. So it comes down to this point that I was saying earlier. Let's take any general purpose chain that exists today. What do you have? You have a implementation of Morpho on it. You have an implementation of Aave on it. You might have Euler on it as well. And then, by the way, name like 5 more like longer tail lending protocols. Do the same thing on the DEX side, right? You're like, I've got Uniswap, Sushi, QuickSwap, Aerodrome, like, and most chains literally have like 30 DEXs, if not more. What happens is that you get $100 million of liquidity that sits in, let's say, Morpho. You get $100 million of liquidity that sits in Aave, and you got $100 million of liquidity that sits in Euler. That's $300 million of liquidity. But the thing is, you can only tap into $100 million for any sizable trade without like having the issues related to like slippage and just pricing in general, or specifically on this side, like borrowing and lending rates. If you were to take all of that liquidity, all 300 million, and just put it into one protocol, you now have much deeper liquidity. You can do much more sizable lending, borrowing without actually affecting rates. On the DEX side, you're not going to affect slippage in the same way. Now, you have to assume that if you don't bring those 3 protocols and you only bring one of them, you're not going to get $300 million of liquidity. You're going to lose some. So what are you going to get? You're probably going to get $150, $200 million of liquidity. So then you ask yourself, are you better off with concentrated liquidity of 150 to 200 million, or $300 million where the deepest liquidity that you have is $100 million? And the answer is like pretty easy. Just like, if people want deep liquidity, because that's what users tell us that they want, let's build a thing that actually brings that deep liquidity. And then the same thing is true with respect to assets. Very interesting. This is the one that's like a little less obvious. I think the protocols, honestly, when I walk people through it, they're always like, oh yeah, duh. On the asset side, it's a little less obvious. But if you think about it, you've got so many versions of like wrapped BTC, WBTC, CBBTC, TBBTC. I could keep going down the line of like lists of like wrapped Bitcoin. Those are virtually the same assets. At times there's some like differences in how they're secured, but like frankly not actually meaningful once you dig into it. And most people are willing to hold any of those assets. It's not uniformly true, but it's very often true. And if you have $100 million of WBTC, $100 million of CBBTC, $100 million of TBTC, that is significantly worse than just having $300 million of WBTC or even $200 million of WBTC. Now, what happens though is there are different people who want different things. Some BTC holders are like, I want something really, really secure. So I want something that's like secured on Bitcoin. Versus somebody who says, hey, I'm more of like an Ethereum person. I'm okay with like multi-sigs holding my assets. And so maybe what you end up needing is actually two versions of these BTC assets that meet different needs. The point is there's a subcategory of people that want like have different needs. All you need to do is meet their needs, not have every version of these assets. And once you do that, you can deepen the liquidity in what is virtually the same asset rather than fragmenting liquidity across all of them. That results in less TVL. It results in significantly more actual value for users on the chain.
More value is better user experience or more yield?
Yes, better user experience. We can also get to the yield part if you want, but definitely better user experience for anyone who's looking to do anything that could create any kind of slippage or like move borrower lending rates in a meaningful way.
Yeah. How did you come up with the partners? I think I'll get this. Some of them right, like Morpho, Sushi, I think Lombard. I think you guys partnered with Agora on the stablecoin. Like, how did you actually make these decisions? Is it whoever gave you the best rates on things? Is it what founders you like the most? I'd actually love to hear just like a behind the scenes of these.
Yeah. So there's multiple approaches. On some of them, it was a pure RFP. We sent it out to the top teams and we said, hey, what are you willing to bring to the chain? And very importantly, the decision-making on who we initially approached had a lot to do with like the security that they could bring in the asset or in the protocol. And the simple reason is like, this is a like core aspect of the chain. If this fails, it's actually problematic, right? Like if you think about like, where's the risk on Katana, it's on like the failure of a protocol. So what you want to do is you want to build choose protocols that are like very, very secure, solid audit history, solid actually like history in production. And those are really the teams that you want to work with. That's number one. Number two is, people like to say like chains are everyone's chain or whatever it is. I think of Katana as like the user's chain. Basically like users get everything thrown at them in Katana. Like every bit of value that can be taken from a chain, from its partners, gets thrown at the users through yields, which we could talk about. So when we look at this, a lot of this had to do with like, okay, what are assets that users want to hold? What are protocols that users want to use? I don't want to choose an asset that protocols like that users don't want to hold. I don't want to choose a protocol that don't want to be used. And then second is, what are you willing to bring to the users on Katana from an incentives perspective or other value? I'll give as an example. Sushi has a percentage of its revenue that actually goes to chain-owned liquidity. Effectively, what this means is a percentage of the Sushi revenue actually goes to creating liquidity on Sushi themselves in various tokens, so that when there is a bear market of some sort and many people have decided to pull out their liquidity, in Sushi, what you have is liquidity that literally stays in there and that never gets withdrawn.
Oh, so you've got like the sequencer fees and protocol fees and application fees, basically all funneling into one fund essentially, which is like your own. That's what you guys call this chain owned liquidity, and then this becomes now you guys own the capital. You don't become reliant on other people's capital. You own the capital that supports DeFi on the chain. So in up markets, you don't have to worry about that. In down markets, now instead of having capital leave the chain, you have this embedded liquidity, which can be maybe the difference between a chain doing well in volatile times versus not doing well. Is that a decent?
Yeah, I often think of Katana as being like, I think it's easy for any chain to do well in a bull market. Frankly, right. It's not that hard, especially the DeFi oriented chain The hard part is what happens when times get tough. And that's ultimately the key thing here trying to be solved is there's two things that make this really interesting on Katana. The first is the chain owned liquidity, right? Again, people pull up the liquidity, but you've got a baseline layer of liquidity that you can still trade against. The second one is when we look at these different sources of yield, some of them are actually off-chain yield. So something like AUSD. AUSD is a stable coin where Katana Foundation actually receives the revenue and redistributes that out to users. That is off-chain yield. So when you are in a bear market and DeFi yields drop significantly, what will actually happen is that yield on the AUSD is actually going to be much more desirable than the on-chain yield. And that is something that allows like disproportionate earnings for users in a bear market that you don't actually get in a like frankly just anywhere else because they're not built for it.
I wanted to take a moment to tell you about Focal by FalconX, the AI-powered insights engine built for institutional crypto. With Focal, you can create charts and generate answers to questions in seconds. Used by over 80 funds with more than $10 billion in assets under management, you'll feel like you have a team of analysts at your fingertips. Ask Focal questions like, what's causing the uptick in liquidations? How much Bitcoin did Michael Saylor buy last year? And what is crypto's correlation to traditional markets? Focal pulls data from trusted sources like CoinGecko, Token Terminal, and the tie with enterprise-grade privacy and security. Learn more at askfocal.com or check the link in the show notes. Thanks to Focal for making today's episode possible. Ever wish you could access cash without selling your Bitcoin? LEDN, the global leader in Bitcoin-backed lending, makes that possible. Since 2018, they've issued over $9 billion in loans, and not a single Satoshi of client funds has ever been lost. Here's what makes a LEDN loan different. With custodied loans, collateral is not lent out to generate interest. No credit checks, funds in less than 12 hours, and no monthly payments. Repay whenever you want with zero penalties, and they don't just talk security, they prove it. LEDN offers proof of reserves reports verified by a top accounting firm every 6 months. LEDN is 100% focused on doing one thing better than anyone else, giving Bitcoin holders a secure, transparent way to unlock liquidity without selling. Click the link in the show notes to find out more. As always, investments in blockchain technology involve risk, terms, and conditions apply. What does this do to the actual yield for users on the chain?
Yeah. So yield's really important on this chain for two reasons. We talked about like all of these assets and all of these protocols, right? The question becomes like, how do you actually get Sushi and Morpho and the Lombards and the EtherFis? Like, how do you get them to actually be like the assets here that people adopt? And how do you not fragment that liquidity? And it all comes down to like incentives. Just incentivize those assets, incentivize those protocols. Do not incentivize anything else. This comes down to this point of being opinionated that you made at the beginning, right? And if you do that, if you imagine another DEX coming to Katana, the disadvantage that they're going to be at is absolutely massive, such that they will get no adoption compared to Sushi. And the reason is because of the yield that's funneled there. I think of it as like there's like 5 sources of yield that exists on Katana. And you've got kind of 3 sources that we'll call like real yield. And then we'll call like 2 sources that you call like token yield, which is like the typical yield that you get, right? The typical yield that you get is like a token called CAT, right? Where there's going to be a significant airdrop to pool holders. So, well, really pool stakers specifically. So it's interesting in that sense for kind of like that incubation. But then on top of that, so that's all going to flow through. And by the way, when that flows through the users, it flows through those core protocols and those core assets. So you're only incentivizing those. On top of that, the core protocols, they all bring incentives. So Morpho incentives, Sushi incentives, those all flow through those core protocols. So again, you're incentivizing just those protocols and then certain assets that you pick. But then on the real yield side is where it really gets interesting, because every chain has that. Right? Every new DeFi chain comes in, they pump you with a ton of incentives. The incentives eventually disappear, or they do really well and those incentives last like a little bit longer than they would. But eventually, those incentives, A, are volatile and people can't really price them well, but B, end up actually not existing for forever. So Katana has like 3 other yield mechanisms. The first one is a protocol actually built by Polygon that is used called Vault Bridge. So this is a protocol that's actually available to like actually multiple chains. There's actually a lot of chains that will be adopting Vault Bridge in general. You will see this soon. It's become one of the more popular products of Polygon where you just haven't seen the launches come out yet. Yeah. And Katana uses it. And effectively what it is that all USDC, all USDT, all ETH, and all BTC that is deposited into the chain is actually deposited into Morpho vaults on Ethereum. Those assets get lent out. They earn a certain amount of yield. So users are taking more risk here. Now, why is this appropriate? It's simple. It's a DeFi-centric chain. If you want to earn more yield in DeFi, you do it on this chain.
And you're just automatically making these decisions, right? You don't like a user doesn't opt in to put it on Morpho. It just automatically goes into Morpho. Right?
Automatically, users are told that's where your deposits are going. They know that it's for going. They earn that that yield gets earned. That yield does not go straight to users. Passive users are terrible for DeFi. They cost you security on the chain. They add no value. That actually goes to Katana Foundation. Katana Foundation then chooses how to use this. So all of that yield goes straight back into those core applications and into those core assets, incentivizing them. We now have, I think, $150 million of deposits on Katana. That is generating probably $7.5 million or so a year already. You push that up to $300, $400, $500 million, you're talking about tens of millions of dollars going straight into these core applications and all flowing through to the applications built on top of Sushi, Morpho, and the other core applications. And then the users ultimately getting that benefit. Second one is AUSD. Some people are not going to like this bridge mechanism. They're going to say, this is a risk that I'm not willing to take. Who's going to do that? Mostly institutions. The thing is, this chain is actually one that should be desirable both for retail and for institutions. Retail is going to get more yield. Institutions are going to get deeper liquidity. So we want to offer them an option. So we've been working with Agora, which has AUSD. It's a stablecoin that shares yields with Katana Foundation. So institutions can receive a native stablecoin on Katana, take no bridge risk, use it in Katana, and then that yield goes right back into these core applications and core assets, including Agora as an asset. So again, that's more yield just flowing straight through. And then lastly, this is a sequence chain with a single sequencer. And so ETH is earned. And so when that ETH is earned, initially that's all going to go to creating chain-owned liquidity, deepen that liquidity, take a very long-term view. Once that liquidity is deep enough in the core assets that you want, you start taking that and passing that right through the core applications to the users as well. And so now what's happening is users are actually not only just earning token yield, they're now earning USDC yield, USDT yield, ETH yield, BTC yield, and AUSD yield. And that is actually like real stable yield in like a very sizable way.
Huh. It's funny. There are these like themes, time and time again, you see these things in crypto that didn't work. And then you slightly tweak the model and it comes back and it works. It's like, everyone knows like Olympus DAO, obviously, and like they had protocol liquidity and blew up and stuff like that. But like, I don't know, it's kind of it's like Olympus DAO meets like what Faye was trying to do. And then there's some element of like the curve wars and like what Balancer had tried to do with like combining voting and emission. And but you guys, I don't know, it's maybe I turn that into a question. Like what have you guys learned from like studying the failures of the past?
Okay, so this is interesting. So first of all, it's funny. People compare this to a lot of things. It's Barachain, it's Blast.
And
the thing is,
it
has a lot of elements from things, right? There's elements of Barachain, there's elements of Blast, there's elements of Olympus DAO. Ultimately, like I think people focus on the mechanics behind Katana too much, and they don't actually focus on like the bigger strategic difference. The core assets and the core protocols. That is actually the differentiator. The mechanisms are just how you actually make that come to reality. That is really it. That being said, Olympus DAO is in so many Telegram channels and Slack messages. Looking at them. Actually, funny thing is, Olympus DAO is failed. Olympus DAO has one of the biggest treasuries in all of crypto. And that is the whole idea with like the chain-owned liquidity. It's like, that's technically like a treasury, but not really, right? Like it's going to be like owned by the protocol, but like the amount of value that can actually accrue there is very significant, the way that you've seen in Olympus DAO. We've learned from Blast. One of the big mistakes from Blast is you deposit into Blast and you receive an asset on the other side. You hold that asset and you earn yield. Well, what that does is it means that now the chain has a security cost associated with it. Somebody's got an asset there that is being secured, and no value is being added to the chain whatsoever. That adds a lot to TVL. It's very easy to attract TVL in that way. Katana very much rejects that idea. You do not earn any of the value until you actually use protocols. This is the concept of productive TVL. We want TVL that is actually used rather than TVL that just sits there.
You don't want users just getting 5% a year and just sitting there.
I mean, there's lots of ways that they can do that, right? That's okay. But why don't you earn 8% a year while depositing into Morpho instead? Go earn your L1 yield and then earn the full L2 yield, and that's the yield you can earn. If you want to earn 5% somewhere else, that's okay. Katana's not the place for you. And that's fine. Again, opinionated chain, right? Then there's other things that you look at I think the mechanisms that you see in Berachain around kind of their proof of liquidity. You see some of that replicated in kind of the mechanisms that exist in Katana. I think one of the really interesting ones is the curve wars. This is something that we don't talk about as much because CAT is not tradable right now. But one of the cool things about CAT is that when it is actually tradable, you'll be able to deposit it into a you'll be able to lock it and receive what we call VCAT, just a voting cat. And you will then be able to direct emissions into different sushi pools and receive fees from that, similar to how you see that on Aerodrome. And so that's another mechanism where we've looked at a lot of protocols and seen it and stuff. So mechanisms bring together all of these different protocols, but ultimately the key thing is, to me, is this strategic difference on concentrating that liquidity and driving it all to drive higher yields and deeper liquidity that gives users what they actually want in DeFi.
Marc, if you ask a bunch of founders of different chains, who's your customer, they would say actually founders and builders. And we have chains who come to us all the time because we make money from advertising and sponsorships and stuff like that. And we're who do you want to reach? They're I want to reach new developers to build new apps on the chain. You don't have to worry about that problem at all, or because you've already picked the apps, or you still care about the founders and the app builders as a potential customer down the road?
Yeah, we very much care about them, right? Because ultimately you've got this base layer, but then I want thousands of applications built on top of them, right? Yeah. They're all tapping into the same liquidity. They're all tapping into that yield. So ultimately, and this has been when Katana launches, it will launch with quite a few apps right off the bat. And the reason it's been relatively easy to attract both high quality apps as well as long tail apps is because they actually know that they're going to be able to offer their users higher yields by building on top of the core protocols than they would if they go build anywhere else. And on top of that, as they bring more size, they'll be able to do it with more kind of in bigger size than they could do anywhere else, simply because of that deeper liquidity. And the same is true for institutions. When we have conversations with fintechs, and they're hey, I want my users to be able to earn on their deposits. The problem for a lot of them is the volatility of what is actually earned. If you've got a pool with $10 million of deposits, then your APR is just going up and down like that. And that's not an experience people want. You want some consistencies. If you actually build really deep liquidity, then you can come tap into that with consistency for your users. And that's something that fintechs are actually willing to offer. So ultimately we hope to have thousands of builders come build on top of them. And a lot of that also has to do with how we approach this. So GSR has been really important in this part, which is, again, this whole liquidity aspect of it. So if you want apps to come build, you need apps to make more money. Okay, apps are going to make more money because people are incentivized to use the chain. But you ultimately need the users to be able to come very easily. And the way this is done on Katana is a few things. First of all, there is the default experience is a subsidized solver experience. So onboarding to Katana literally takes a few seconds and is free. This is actually very, very important because if you're an app builder, usually what you're used to is somebody needs to go to a site, bridge over there, come over there, and then blah, blah, blah. Or people try to claim that that's different for L1s, but it's no different than an L1 because you need to go to a centralized exchange, deposit your assets, move them from the centralized exchange to the L1, and then you can start using it. By subsidizing solver fees, you can have anyone who's in Web3 in general depositing from probably 60 plus chains in seconds for free. And users can start using the apps in the ecosystem like immediately. And that is kind of like, I think, a very big value add to builders that is not like directly to builders, but makes it that so much more desirable for their users to actually like come to the chain.
Yeah. Maybe as we think about tying all of this together and wrapping up this conversation, Sandeep, I don't know if you're done with your walk and you've got enough steps in here, but Sandeep, maybe I'd go back to you and just think, get your take on like, if this is wildly successful, right? If Katana works, if Polygon POS works, if the Agglayer works, like what is the vision of the future? If all of this, if you're wildly successful with all of this.
Yeah, I mean, if all of this is wildly successful, that means that Agglayer combined with all of these chains, OKX's Xlayer and many other chains, they succeed. That means that Agglayer will become that liquidity hotbed where if you are launching anything, you would want to launch connected to the Agglayer, right? And Agglayer provides you that interoperability and all that. And that's the future vision. Like I see, like people laugh at me when I say that I predict 1 million chains, right? People are like, we have like 500,000 and that. I think that, in 10 years, give it long enough time. If the trustless compute has value, which I think like, enterprises are realizing, like, crypto was never bullish, not that bullish for crypto itself. Like, I'm saying now what is most bullish is that now enterprises realizing that this is better financial infrastructure because your counterparties can simply, launch or like, kind of connect to your trust machine and they don't need to have like those deep integrations. And as a whole, the financial system is much more auditable, much more, transparent and all that. So if everybody is coming and those 1 million chains are coming into the space, then Agglayer will become that avenue where all of these chains would want to connect. Because Agglayer is very different. Like you earlier said that, directionally, it's similar to Superchain and this and that. Like Superchain and some of them, they are like very, the Superchain wants to create like a, like an environment of 10, 20, 30, 100 chains probably, which work very closely together. And, you think like, and this is basically, again, the thought process is like a limited, kind of compute requirement of the world versus an unlimited compute requirement of the world. That's the only difference actually, like in that. So the Agglayer is built in a way that there is unlimited compute requirement in the world, right? So more and more chains can connect and, you can have like 1 million TPS aggregated on Agglayer, right? Like, where all the chains are working. So yes, to answer your question, if it's like wildly successful, we want to see Agglayer as becoming that important element of this trustless internet that is being created, which is a subset of the overall internet, of the data internet, which is the value internet. And the Agglayer is an important element of that.
Yeah, and like just building on top of that, like I think I always think of it as the Agglayer should make all of Web3 feel like one chain. It's just that simple. Like that's the experience that we ultimately want. So like everything else that like you build around the Agglayer is important to like kickstart network effects. We want to make sure it's like trustless. Like we know there's going to be hundreds of thousands of chains, and then hopefully more than 1 million chains. Tend to agree with Sandeep on this. But ultimately, like the thing that matters is that when people are using these chains, they have an experience that lets them feel like the internet does today, which is just one internet, and it should feel like one chain. And they are going to want to go between chains. If you narrow and niche chains down enough, they're going to want to go from one place to the other. It's unavoidable. And we need to do that in like a very, very seamless way, which is the goal of the Agglayer.
Yeah, it's a good way to put it, Marc. It feels like there's one internet, obviously. It needs to feel like crypto very soon needs to get to feel like there's one chain. I like that framing. Sandeep, as you go back into to like use the very overused saying at this point, which is like, it seems like you're going back into founder mode at Polygon right now. Like, are there any misconceptions that you think the industry has or people have about Polygon that you are looking to kind of reshape?
Yeah, I think like, not misconceptions, I think right conceptions. Like, these are not misconceptions. Like we, in 2021, when we acquired all of these ZK teams and all that, we were a very heavy, BD heavy, project, right? And we went into a very research heavy mode, right? So imagine like the project pivoting from one extreme to other extreme. And then also, we evaluated multiple different protocols in between, like, okay, do this, like Plonky 3, ZK EVM, this, that. And, like the markets unfolded only now. Like now you see that ZK is largely commoditized, right? Like, it's what you need is the ZK networks and all that. So I think, like, it's not a misconception. Like you also have heard, and I think you also told and multiple people have told that Polygon is doing too much. There's so much going on, like Maidan, ID, this, that, like, we were thinking in that direction. But I think now what we have done, and that's the part of the founder mode, is the laser focus on building few things. Rest all have been spun out. Maidan, ID, this ZK proving, Zisk recently with Jordi, which is a ZK VM and all that, all is spun out. Polygon is going to focus on core product, which actually serve the end users in a better way. That's the whole thing.
Yeah. Sandeep, is there anything that feels very obvious to you right now that you think other people in the industry are missing?
Oh, yes. That's like the Agglayer, for example. Yeah, especially like, again, like I can go on about it all. I internally keep saying that, I always draw inspiration from like what Jeff Bezos says about AWS. That, the AWS for first 7 years, people didn't even realize that there is something meaningful, right? Like they're like, why do you need this and all that? And many people also feel the same way about like Agglayer. They think that, there are some bridges, third-party bridges or intent providers and all that, like, but they are not realizing is that Agglayer is providing one single security zone. Like all of these bridges and all that, separate the security zones when the assets are traveling. And at scale, you will have absolutely no idea what thing is going where and what is securing that and all that. You actually need one single coherent security environment that we have in the form of, let's say, TCP/IP or www, HTTPS on the data internet, which I call like data or information internet. This same will be needed in the value internet. And I think that is one thing like I deeply, like many people have spoken to, and like all of them see, yeah, it's a great idea and all that, but I don't see that, okay, this could be the thing. I think that's what, like, people don't see it, obviously. I see it so clearly.
I think the corollary of this, by the way, is that it kind of goes hand in hand, is that every chain, and Sandeep said this multiple times, but I think it's so not appreciated yet in the industry, every chain will become specific to a purpose. And I often say specific to a purpose by choice or by force. And by force, I mean by market force, right? Like what's going to happen is, I often say, like, if you want your general purpose chain to be great at DeFi, like I guarantee you I'll build you a better DeFi chain. If you want your general purpose chain to be good at payments and RBAs, I guarantee you I'll build a better chain that does just that. And I think that is going to play out like very obviously. It's just obvious, right? So often people say like, well, what's different from a technical perspective? I mean, we just walked through Katana. Like I could give you 10 things that I could not do on a general purpose chain on Katana. I could do the same thing on like the part payments and RWA side, but there's a part that's even more important than that. I was in Hong Kong the other day. I was at a dinner with somebody, running a very big enterprise in China. Not interested, frankly, in the conversation. And then I say, Polygon POS has actually turned its focus almost entirely to RWAs and payments. Literally starts asking questions 5 minutes later. He's like, can we have a meeting tomorrow? And that had nothing to do with anything technical or engineering or anything of that sort. It had to do with, I know you're focused on this. I expect you to be able to give me more support. I expect your ecosystem to be more comprehensive for this purpose. That is just how every market has ever operated. Things niche down with time, and
100%.
Those niches win. And there's no way that is not true on a blockchain as well, especially if you've got the Agglayer that allows you to still benefit from users and liquidity on other chains.
100%. Yeah, could not agree with that more. That feels like a good place to wrap. Marc, Sandeep, thank you guys. For people who have not checked it out, we didn't even talk about Katana. You guys have these cool boxes. People should check out the boxes. You can win a prize. Actually, Marc, you want to give 30 seconds on this so I don't completely botch what is happening with Katana right now?
Yeah. So Katana's got one really cool experience, which is that you can actually deposit funds and receive effectively these crates.
It's very cool, like gamified, like
it's a very
onboarding.
gamified experience. Yeah. You have the chance of winning 10 million CAD, a crypto pong, things like
Yeah.
that. You also have like another avenue for deposit. That's kind of like the let's get the gambling addicts of Web3 to use that. And then we have like the more I need 50% yields people who, because that's very normal, of course, who can go to Turtle Club and deposit and earn yield on BTC and some stable coins. So check it out. It's a fun experience, and then you'll be right on Katana using it when it launches at the end of June.
Epic. Congrats. Marc, Sandeep, rooting for you guys. Thank you for the time.
Cool. Thanks, Yano.